Okay, thank you very much, ladies and gentlemen. So I'm not going to be talking about companies. I'll be talking about the commodity, and I want to focus on very interesting developments in the nickel market. I've entitled my presentation "The Battle Between Booming Battery Demand," which is obviously the talk of nickel over the last few years, and now booming Indonesian supply. And I could add there's probably another battle which is very important for nickel as well, and that's one between Russia and Ukraine, given that one of the world's largest nickel producers is based in Russia. What we see, the background to nickel is we've come off 2021 as one of the best years ever for nickel producers, with the exception of one thing. They all lost production, so it wasn't so good for them from that perspective. But because of them losing production, lots of strikes, accidents, etc., combined with booming demand, the post-COVID period, you saw an incredible increase in nickel demand last year. And global production of stainless steel, which is the biggest end use for nickel, was up 13% year on year, which is, the trend growth is 4 to 5% a year. So it was almost 3 times bigger than the normal trend. But I would say that, what we see now is the ending of that booming period, the post-COVID period. Obviously, the other thing that's happening is China is slowing down because of the COVID lockdowns in China. So COVID-2 in China. On the electric vehicle front, last year was a banner year as well. Doubling of sales globally, 100% up. Nickel demand was up 80%. It grew slightly less than the EV sales because there is a move in China to use non-nickel containing batteries, the so-called LFP, lithium iron phosphate batteries. Notwithstanding that, the nickel intensity of batteries being used in electric vehicles, being deployed in electric vehicles in North America and Europe, is getting more nickel rich over time. And so what we see is very, very strong total demand for nickel last year, up 17%, over 400,000 tons. This year, we're still looking at pretty good growth, 6-7%. Now, what I would say is that could be subject to some downgrade if some of the worst economic forecasts come to be realized, but certainly we're in a very uncertain period. But the underlying demand drivers, particularly on the battery side, still remain quite strong. The biggest problem for batteries is the constraint on supply, shortages of raw materials, waiting times to buy a vehicle. Pretty much in Europe, EVs are sold out for this year. So, there's not much you can really do to change whatever the growth rate there is. The supply is the big issue for nickel. Last year, we had record levels of disruptions from a number of producers, including our friends in Russia. Also in Canada, there was a 6-week strike at Vale. But this year, we see a very strong recovery in supply, and that's really going to be hanging over the market. In the UK, people like to talk about the wrong type of snow. Well, in some ways, the Indonesian supply is the wrong type of nickel because it is high in CO2. And the other thing is it's controlled mainly by Chinese players. So you've got the geopolitical concerns about China accounting for over 80% of the supply of the nickel raw materials for the battery market. And you've also, got the high CO2 issues, which I can talk about in a minute as well. Notwithstanding that, there's virtually no investment in nickel supply outside of Indonesia today. It's just above zero in the overall scheme of things. Lots of projects, but actually financed, committed construction is very, very low today. So what we see on the nickel market is gradually the market is cranking into a small surplus. I'll mention the other elephant in the room in a minute on nickel, which is the big short squeeze in March, but that's another factor. I can talk a little bit about that, but the real drivers of nickel are supply and demand, and that's what I'd like to focus on rather than some of the trading activities, but that obviously has been quite a significant factor in the market in the short run. The medium term, I would say there still is a big question mark about whether there's going to be enough supply. I think we can only really, my crystal ball is very hazy beyond the next 2 or 3 years, both on the EV front and also on the supply front. But it does look to me as though we're gradually, the growth rate is so large for batteries that eventually we're going to start to see the real strains on the supply side of the system. I think it's not there today. It was there last year because of the disruptions to supply, but it's not. But the Indonesian supply is now taking care of that. All that preamble, I've only finished my first slide, but I'll try and move it a little bit faster now. But yeah, when we look at the end use, if you look on the left-hand side, you can see that batteries are still only about 13% of demand. So we're still in the foothills of the battery growth story. The market penetration of electric vehicles last year was 8% of the total vehicle market. By 2030, it could be 40%. By 2040, it could be 80, 90%, may even be 100%. We don't know. But the other thing that is also interesting to note is the dominance of China plus Indonesia in the nickel market now. If you go back to 2000, China and Indonesia were less, or only about 5% of the total market. Last year, they were 70% of demand and 60% of supply. And this year, it's going to be even higher, maybe 72, 73% of demand. So, we're a lot of producers in the Western world think that they are the market. They're not the market. The market is actually China. And China plus Indonesia. Some people call it Chindonesia, but certainly a lot of the investment in Indonesia is Chinese based, and it's to feed their own demand. China is in Indonesia over 2/3 of world stainless steel production, and they're over 80% of the raw materials for the battery industry. What we do see, though, in the nickel industry is the dominance of the London Metal Exchange in pricing is being challenged. What is interesting, though, is that almost half of all the nickel produced today is this so-called nickel pig iron, NPI, which is made in Indonesia and China, which is consumed in Indonesia and China. And the LME deliverable portion of the total nickel market is only 1/5. And, that compares with 75% for copper and 65% for aluminium and zinc. So the proportion of LME deliverable so-called class 1 nickel is diminishing in terms of the overall market. And the other trend that's developing this year is that the Indonesians are converting some of their nickel pig iron furnaces to make nickel for the battery market. So they're further squeezing the supply of metal. The traditional metal is now a small overall driver of the nickel market. If you look at the metal, though, the LME stocks fell tremendously over the last 12 months or so. From over 300,000 tons, they're now sitting just over 70,000 tons. So we did see a huge deficit or shortfall of the class 1 metal. And at the same time, we're starting to see the other parts of the market move into oversupply. So the issue is, are they separate markets or are they interlinked? Personally, I think they're interlinked, and I'll explain why in a minute. And this is the performance of nickel over the last few years. The left-hand chart shows the daily prices in 2020, which was an average of $13,800 a ton. 2021, $18,500, so reflecting a very big recovery in demand, very big fall in inventories. If you look at the chart on the right, you can see inventories fell in every month of last year, with the exception of January. But what we saw was a big surplus in 2020 as a result of the COVID lockdowns, followed by a massive deficit last year. What we see now, if you look at the chart on the right, is the inventories are starting to stop falling. We're starting to get back to some sort of equilibrium between supply and demand, but that didn't stop the price from going through the roof. These are only the official prices. As you probably know, in early March, the price touched $100,000 in unofficial trading, which was cancelled by the London Metal Exchange. So what we see now is a gradual return to some sort of fundamentally justified price. So there was an artificial squeeze, a series of players in China, not just one. Everybody talks about Qingshan, but other players were shorting the market, and they got surprised by the Russian invasion of Ukraine, the concern that there would be sanctions against Russia. The nickel price moved in the other direction, and that led to a massive short covering rally. We're now still dealing with the aftermath of that event, but as you can see, the price is now starting to head lower again, back to the pre-March events. So, we're getting closer to some sort of clean supply-demand driven price. We didn't have that over the last 2 to 3 months. That's caused a lot of angst, as you can imagine, in the industry, because they don't know how to price their product. I think it's become a real challenge for the industry. And, that is further complicated by the fact that in the past, everybody focused on the LME price. Now there are now 3 prices for nickel. The dark blue line, the bottom one, is the nickel pig iron price. You can see it barely moved up in response to the events of March. In fact, it's now coming down, and the reason for that is the weak demand in the Chinese market today. And the second price, the nickel sulphate price, the light blue, that should be trading at a premium. If you look at the next 2 charts, you look at the premium or discount of those other prices to the LME. Last year, nickel pig iron was a premium to the LME because there was a shortage of nickel when stainless was booming. Now it went to a massive discount. And secondly, with the nickel sulphate, that went to a huge discount, even though you need nickel metal from the LME to make nickel sulphate, and it costs you $1,000 more to make it. So, we've seen massive dislocations in the market. So, the question is, what is the nickel price? Bearing in mind that 50% of nickel supply is nickel pig iron, for half the world's consumption, the nickel price today is $22,500 a ton. What we see, though, is a gradual recalibration of the market. But these dislocations in the price do have consequences, and I'll explain one of them in a minute. So last year, this is the global picture for nickel supply and demand over the last few years. And you can see what happened last year was this big chart on the right, big increase in demand, highest ever seen in the market, spread across batteries and stainless steel and other markets, platines, alloys, etc. And that was not expected. A year ago, most people were still sticking with maybe 200,000 tons growth. Instead, it was 400,000 tons growth. Then on the supply side, the increase in supply from the orange bit, which is Indonesia, was large. But actually, at the start of the year, people thought it was going to be 350,000. It was only 240 because of the COVID-related disruptions to building plants in Indonesia. And secondly, you saw the green bit, which is the rest of the world, went down for the second consecutive year. And, if we look at the changes, you'll get a copy of the slides, I'm sure, but if you look at the changes in year-on-year changes in supply by producer, there was a whole bunch of producers up here that lost production. The leading one was Norilsk, Nornickel, 43,000 tons down year on year. And the reason why they lost production, their 2 major mines flooded and they were out of production for a few months. And they also had a lot of the concentrator plant collapsed. This is part of, some people say it's global warming, the melting the permafrost, all those sort of things. But there's definitely some issues regarding their operations. And also you saw a lot of maintenance outages. So there's over 130,000 tonnes taken out of the supply chain. By contrast, if you look at the plans for this year, the chart on the right shows the major listed producers. They're all planning to increase production this year after the falls of last year. And so far, I would say, we've got the first quarter numbers. They're a little bit lower than expected, but we allow for that in our disruption allowance of 130,000 tonnes for this year. But pretty much everybody is planning to increase production this year. Now, whether they can achieve it, it remains to be seen. Russia, while we're on the subject of Russia accounts for about 8% of world production, but it's about 26% of LME deliverable nickel. So it's quite a big, important factor in the LME. And in Europe, Russia accounts for almost 1/3 of total nickel consumption, and it's not really possible to replace it at the moment. So that is really quite a big issue in trying to control that. There are no official sanctions against Russian nickel. There is no, so far, there's been no disruption. The material is still flowing. Over 90% of Russian material was sold under annual contract this year, and all those contracts have been honoured. So, so far there's been no disruptions, but, that may change. I mean, there's a lot of unofficial sanctioning, particularly banks not extending credit, shipping companies, some of them not carrying the material, but Russian flagged vessels are still delivering material. China, I think the worst case scenario would be if there was some disruption to Russian supply in Europe, China probably could take quite a bit of it. If you look at Chinese imports of material from Norilsk in 2015-16, were almost their entire production. They've fallen in recent years because they don't want it. They've got this nickel pig iron coming from Indonesia. So, that's an alternative source of material. But if the price was right, I think a lot of that nickel would flow in a easterly direction and material that is currently supplied to China from Australia, Canada, South Africa, etc., could find its way into Europe. So it's not. At the moment, we don't assume any significant disruption. The nickel pig iron price did not follow the stainless price up, and that's because we think the nickel pig iron price is more related to what's happened in China in terms of production cost. So the green line is the nickel pig iron price, and the black line is the production cost of nickel pig iron in China, and it's kind of more related to that. And the chart on the right shows the nickel pig iron price against the Chinese stainless steel price. So it's kind of got a world of its own. At a much lower level than the LME price. And you can see Indonesian production costs are way lower than in China. And that's because the ore price in Indonesia is much, much lower than the ore price coming from the Philippines into China. So moving on to the demand side, what worries us is if you look at the composite PMIs for the world, they've gone below 50, which is normally a sign of slowing industrial output. You can see that China is the major concern. Now, we know that China has a habit of turning on a sixpence. They stimulate their economy and then suddenly it recovers again. For the moment, though, China is very, very weak. And that's obviously having a negative impact, not just on nickel, but on a number of other commodities. And if you look at global industrial output, which is very highly correlated with metals demand, it's actually gone negative in April, according to our estimates, driven mainly by a 6% decline in Chinese industrial output. So in terms of stainless steel, which is 2/3 of nickel, just over 2/3 of nickel demand, the chart on the right shows the quarterly world production. It peaked in the second quarter of last year. And actually in the end of last year, the first quarter of this year was negative growth year on year, mainly driven by China, I should add. Although European production was down 6% in the first quarter as well. But we're assuming that in the second half of this year, the Chinese will get their act together, stimulate some infrastructure investment. The difference between this time in terms of China versus 2000, in 2000, Chinese growth recovered out of COVID incredibly rapidly because they exported loads of goods to the rest of the world. This time round, maybe that avenue growth recovery is not open. The rest of the world may be weakening and buying less Chinese goods. So it has to be domestic infrastructure and consumer stimulus in China. And maybe the Chinese authorities don't want to suffer the consequences of massive overstimulation of their domestic economy. They've done that several times in the past, and it's taken them years to readjust their internal economy from the big surge in property, etc. But on stainless, we're looking at only 3% growth this year versus 13% last year. So that's quite an important adjustment. On the electric vehicle front, what we see is enormous growth last year, driven by policy, by incentives, and we're only in the foothills of the electric vehicle story. It's just barely begun. 8% market penetration last year. So I think there's only upside. But there are a number of issues regarding electric vehicles which are going to come to fore, I think, this year. One of them is, if you look at the monthly sales of electric vehicles, totally dominated by China, over 50% of sales. And the Chinese numbers, this is up to March. Chinese numbers are now in April and May are falling very, very sharply because nobody can get out to buy a car. So what we do see is some concerns about the next few months. The rest of the world, Europe is the other dominant market. But if you look at Europe, it's actually been static for the last year. And the reason for that is supply constraints. The European EV makers cannot increase supply fast enough to meet the demand. And, you've got the microchip shortage, you've got the steel harness shortage because a lot of that was made in Ukraine. You've got all sorts of supply issues starting to limit the ability of the European market to grow in the short run. Now, that may change over the medium term, but, that remains a bit of a concern. And, I was quite shocked to look at the European numbers, thinking they were just on a continual upward trajectory. They've actually been a little bit slow. And all that's happened is the waiting list to buy a car has got longer and longer. So that's a little bit of a warning for the short-term outlook for the market. Our medium-term outlook, this is a great chart just showing the ongoing growth. By 2030, we're assuming about 38 million vehicles sold versus 6.6 last year. Incredible growth, dominated by Europe and China, and then the US gradually joining the party. US is still lagging behind quite dramatically, notwithstanding the high profile of Tesla in the market. But I think that sort of growth follows the typical S curve, and this is a rough framework we use to drive it. I must say that when you look at the forecast by all the different players in the market, they're all over the place. From as low as, by 2030, from as low as 28 million vehicles to as high as 50 million vehicles. And that makes a huge difference to these numbers. The other thing that is important is the battery technology. And I don't want to get into too much detail, but the chart on the left shows all the nickel content and the cobalt content, lithium content of all the different batteries. Lithium is the common factor in all these batteries, but there's a huge variation in the mix. The chart on the right shows our particular forecast, which is that lithium iron phosphate will be about 35% of the market by 2030 versus 25% last year. Some people say it's going to be 50%. Some people are going to say 35%. Some's going to, so it's all over the place. Some people it's going to be 25%. And then, but what we do see is the trend in the market is towards higher nickel because that increases the energy density of the battery, increases the range between charging, and towards no nickel, which is for urban vehicles where there's plenty of charging points. You're not really that concerned about the range. So, one is a cost-driven economy solution, and the other is a higher performance, taking away the range anxiety element. So it's going to be one or the other, or both, or a mixture of both. What we see as the growth is likely to be very, very strong, whatever scenario. But there is quite a bit of uncertainty regarding the uptake of EV sales, and secondly the the battery technology. And if we look at lithium prices, nickel prices, and cobalt prices, they've all shot up. And the cost of making a lithium-ion battery has gone up this year for the first time ever over the last 10 years. Probably gone up by 40, 50% if you use spot prices. Now, is that going to be a problem? At the moment, I don't think it is, because price of an internal combustion engine is going up as well. So, you've got everything is going up, but there's definitely some short-term concerns. I'll move on quickly to the supply side. If you look at the growth in supply by decade, this decade is clearly beyond all previous periods in the nickel market. You've got two huge growth drivers in demand, both batteries and stainless steel. You need over 2 million tons of new supply this decade. It's a lot of nickel. That's 10 Norilsks, 10 Nornickels are needed. And where is it going to come from? At the moment, we can identify there's 6 sort of major areas where it could come from. We think it's going to be dominated by these first two, by Indonesian so-called nickel pig iron or furnaces, or the conversion of those nickel pig iron furnaces to nickel matte, or it could come from these high-pressure acid leach projects, which at the moment there's over 800,000 tons of projects planned for Indonesia. So that's where the bulk of the growth. Sulphide deposits is going to be part of the solution. The problem is the sulphide deposits are mainly located in North America and Australia, where environmental permitting, building things is expensive, raising money is difficult, and the technology of converting sulfides into battery materials is quite complex. Unless you've got some sort of direct way of converting the nickel concentrate into nickel sulfate, you've got to go through a conventional smelting refining process, and there's not a lot of spare capacity. So the promoters of projects in North America and Australia are really depending on the development of direct processing technologies, which have not yet been commercially developed in a proven fashion. So, quite apart from the other issues, I think, we don't see that as the main solution. There's just, the reason why it's not the main solution is not enough capacity. There's not enough reserves. I won't go into great detail, but the problem with Indonesia is going to be high CO2, particularly for the nickel pig iron. It's 50 to 60, maybe even 70 tons of CO2 per ton of nickel. So traditional sulfides are plus or minus 10 tons. Vale said 5 tons. The high pressure acid leach is more or less plus or minus 20 tons of CO2. So the current fastest growing area of nickel is the highest CO2 emitting area. And it's all going to China. They don't even measure the CO2 in China. So, it doesn't really, it's not even part of their thinking at the moment. If we look at Indonesia, Indonesia was 30% of world supply in 2020. It's going to be 47% of world supply this year. By 2025, 26, it's going to be 60% of world supply. This is like the DRC is in cobalt, which is 70%. So at the moment, nobody's building anything outside of Indonesia, but the Indonesian projects are proceeding at a fantastically fast rate. And if we look at the growth in Indonesian production this year, is going to be the record high, partly because of catch up from the delays last year, partly because they've built a whole lot of new plants. And we estimate over 450,000 tons growth in Indonesian supply this year. And the chart on the left shows the number of furnaces being commissioned to make nickel pig iron and nickel matte. Since the start of this year, 19 new furnaces have started, which is almost 200,000 tons of new capacity. It's another Norilsk. And there's another 60 furnaces planned to come on stream between now and the end of the year, which is another 600,000 tons of capacity. If you look at the actual production rate in April, it was 1.36 million tons a year, which is 375,000 tons above the average for last year. So they're already almost there, but they still have only commissioned a quarter of the furnaces they're planning to bring on stream this year. And this is our projection quarter by quarter of Indonesian production growth. And you can see that the share of the stuff for the battery industry, the MAT and the MHP, is starting to grow as well. And the run rate by the fourth quarter is going to be 1.6 million tonnes a year versus production last year of 985,000 tonnes. So it's a big jolt to the market. The problem is there's two problems: not enough processing capacity in Indonesia to treat all of this product. You know, it's even the Chinese are struggling to build the capacity. And secondly, the ore supply in Indonesia has to increase massively this year. And there's already some signs of strains, of delays in getting material delivered to the plants. Ore stocks are coming down. It could well be that they struggle to achieve such a huge growth in supply. But what is clear is that this increase in Indonesian supply is having one ramification, which is to reduce the use of Class 1 nickel metal. In the battery market, the feed source is now going to be more intermediates. You know, over the last few years, they've used a lot of nickel metal. They dissolve in sulfuric acid. When the LME price was $33,000 a tonne, these intermediate products were much cheaper. So you're seeing a switch away from using those intermediates. It's not economic to process. From using LME deliverable material. The same goes for the stainless industry. The grey line is the estimated use of nickel metal in stainless steel. It's going down. And that's because the nickel pig iron is going up. So what we see is in total last year, whereas the Class 1 nickel use went up, this year it's likely to go down. Furthermore, the Class 1 nickel producers are going to increase production by 80 to 90,000 tonnes this year. So we think that the LME market is going to move from deficit to surplus this year, which will have obviously impact on the LME market. And this is our latest run rate for new supply from Indonesia. The nickel pig iron production last year was 850. There's over 2.3 million tonnes of capacity currently operated, planned or under construction. On the high pressure acid leach front, there's now over 800,000 tonnes of projects. Just over the last 6 weeks, VW have announced a new investment in Indonesia. CATL, the Chinese largest battery maker in the world, LG Chemical Solutions, Tesla is now talking about a big investment in Indonesia. President Joko, we went to visit Elon Musk in Texas 2 weeks ago. Pretty much every week there's a new project announced in Indonesia. Now, is it possible to deliver all these projects? That's the big question mark. Secondly, does the world want to be totally dependent on one country for all their battery raw materials? The answer is that it doesn't, but then nobody's building anything. You know, that's the challenge for this conference is for some of you guys who are investors to start financing some of these projects. And these are some of the projects that are out there. It's not a complete list, but you know, there's over 300,000 tonnes of projects, but I would say that there's also a lot of production going down in the sulphide area. Reserves are running out. So quite a few of the production process we see are actually just replacement rather than incremental to supply. The other final thing on the cost of making nickel in Indonesia, this high pressure acid leach stuff, which is for the battery market, just started up last year. It's benefiting from very high cobalt prices. It's a byproduct. The comparable plant is Ramu in Indonesia. They announced in the first quarter to make the intermediate product, which the Chinese want to make in Indonesia, cost them $3,200 a tonne to make. To convert that into a battery ready nickel sulphate, it's going to cost another $2,500 to $3,000 a tonne. So they're producing battery grade nickel for $6,000 a tonne. The Indonesian stuff that's being built is all under $8,000 a tonne cash costs. Current nickel price is over $25,000 a tonne. the capital cost is about $20,000 to $30,000 a ton of capacity. These projects in Indonesia have a 2 to 3 year full capital payback. And, the projects outside of Indonesia can't really compete with that level of cost or capital cost and operating cost. The project in Indonesia that just started up last year, it's called PTOB. They're claiming the same degree of competitiveness. The one thing that's killing these HPAL projects at the moment is sulfur prices. They've gone from $100 to $600 a ton. You need sulfuric acid in the autoclaves. But notwithstanding that, the increase in the cobalt price has more than offset the increase in production costs. So you can see the total costs have gone up, but the net cost after cobalt has come down. So that's really the challenge for the nickel industry, is to compete with what is happening in Indonesia today. If we look at the nickel market, we're on the assumption that there's no disruption to Russian supply. The market was in deficit last year by about 180,000 tons. We see it cranking into surplus through the course of this year as the Indonesian supply hits the market. We're still assuming that demand growth this year will be quite a respectable 6.7%. The historical trend growth in demand was about 5%. Now it's probably 6-7%. So it's kind of trend growth now because of the battery market. But the supply growth is currently projected at 17%. Now, it's never increased by 17% in the history of the world. This number was agreed at the recent April meeting of the International Nickel Study Group. Pretty much every producer that I speak to has similar sorts of numbers. The issue is what's going to happen to demand and what's going to happen to Russia. I think those are the two big issues. But certainly the next couple of years, the market looks quite well balanced, albeit the dependence on China that I showed on my first slide is just going to continue to grow in terms of the market. By the middle of the decade, the booming demand for EVs and batteries is going to continue to create challenges for the nickel industry to deliver enough units of supply to the market. So, in the very short run, we're seeing a rebalancing and small oversupply in the market. Over the medium term, it still remains very strong. But the main message is that there's not enough investment in non-Indonesian supply. And that is going to, I think what it needs, though, probably needs some sort of disruption to that supply to wake the market up to the reliance on one source of supply, or it needs maybe carbon pricing, a focus on the CO2 element of particularly of the nickel pig iron. At the moment, it's not there, but that's kind of how I see it. Thank you very much.
Very quickly, sorry.
Oh, this question.
Obviously, it's incredibly hard to quantify, but what would your guesstimate be if we started pricing proper sort of carbon sensitivities into Indonesian nickel?
It depends what you mean by proper. I mean, I've obviously quite a few non-Indonesian, non-Chinese nickel producers are talking about this because in a sense, it's their only hope. And what, the EU is looking at pricing carbon in, say, if you make a battery in China and you ship it off to Europe, you've got to pay at the border some sort of carbon tax. Now, the price of nickel, let's say it's 20,000, nice round number. If the carbon tax is $100 a ton, this nickel pig iron solution, let's say it's got 50 tons of CO2, then that's 5, per ton of nickel, 50 tons of CO2 by 200 is $1,000. Sorry, $1,000. So it's quite a big component. And if you look at a battery in a car, it will probably contain about 50 or 60 kilograms of nickel. And if you put a carbon tax on it, could add $200, $300, $400 to the cost of the battery. compared to a low carbon nickel from Vale or from BHP or whatever. So you've got to look at the difference between the carbon, and it could start to have an impact. Now, the question I would say is, do you either want the electric vehicle or you do not want it? Because the Vales and the BHPs of this world are not planning to increase their nickel production, but the demand is growing. So the incremental demand has to come from somewhere. And if you don't, the solution is not to build the electric vehicle. But if you do build the electric vehicle, then the EV makers will have to pay the extra, and they'll have to pass it on in the form of a higher price for the car. So I think the people who benefit from the companies benefit from that will be the low carbon nickel producers. But if the market needs the nickel, then it will just be a cost plus type exercise to the end user, is the way I would see it. And some companies like Vale and BHP and Glencore will make more money because they'll either sell their nickel at a premium to reflect the fact that their competitors are having to incur a carbon tax, or the other guys will sell it at a discount, one or the other. But that's kind of, so the answer is it depends on whether there is no alternative. Basically, because nobody's building anything else, it's got to come from this source. That's the issue.
Okay, thanks very much, Jim.
Thank you.